Welcome back, Money Masters. Today we are talking about index funds. Some of you are probably thinking, what is the difference between stocks and index funds? Or how can I invest in index funds? Maybe you are worried about market bubbles or a major market crash and are looking for a more balanced approach of investing. Today we are looking at investing in index funds and the benefits they can bring to you. If you are new to investing or you don't want to lose your gains, index funds are a low-risk way to confidently invest your hard-earned money. Besides, who wants to spend a lot of time researching what stocks to buy just to end up losing your savings in this time of crazy market changes? So, take some notes and don't forget to subscribe to keep receiving our weekly tips on the latest in money, finance, and becoming the millionaire you'd always hoped you would be. Index Fund Basics. To get started, let's talk about what an index fund investment actually is. An index fund is set up as a way to invest in many different stocks within a given index, or in simple words, in a group of stocks. Sound complicated? Think of it this way. A company decides that it wants to follow the ups and downs of particular stocks from specific indexes. So they set up an index fund and draw in investors to put money into this index fund. From here, the company buys stocks in the given index, and those who invested get to reap the benefits without doing any of the real work. Investing this way is a lot smarter than placing all your eggs in one basket. Instead of buying a lot of single stock and hoping its value rises, an index fund offers investors effortless diversification, which helps prevent major losses from stock market fluctuations. If you're giving a stranger or index fund your money, you would like to know how that money is spent and used. For example, if the fund follows a major market index like the Dow Jones Industrial Average, the index fund would use investors' funds to buy stocks from each of the companies represented in the Dow Jones Index. Because of this, the fund should directly mimic the rise and fall of the Dow Jones. If the Dow is up, so is your investment return. If the Dow is down, you just might be losing money. Because of this management style, index funds tend to have low overhead cost, maximizing your actual investment funds. Overall, index funds are a great way to diversify, invest with low risk, and build wealth over time. With this management style, you also don't have someone actively evaluating the markets. Of course, there are some actively managed index investment, and their portfolio managers are making decisions on when to sell and buy certain stocks. This might be risky, but does offer the opportunity to cash in on high stocks and buy new stocks when they are low and rising. However, it is essential to know that in 2019, only 29% of actively managed funds had outperformed their benchmarks. In reality, it is really hard to beat the market, no matter what you do. If the market is falling, so are your stocks. Index funds provide average returns, but offer unmatched safety. The good news is you can definitely expect to earn a profit if you are patient and invest for long-term gains. Major supporters of index fund investing have shouted about the benefits for years now, and people are just beginning to listen. One of the index fund's biggest supporters was none other than the infamous stock picker, Warren Buffett. The CEO and chairman of Berkshire Hathaway, Buffett thought that for most people, the best thing to do is to own the S&P 500 index fund. He thought this due to the fact that the S&P 500 has had an average yearly return of almost 10% for over 90 years. Another major player, Jack Bogle, was the creator of the first index fund. He started the index fund in 1975 and showed big investors that even the little guy could make money in the stock market. John Bogle started as a young man growing up in the Great Depression when his family lost their home. John would work hard to earn a spot at Princeton University, where he studied economics. The company he started in 1975 now has access to over $6.7 trillion in investment funds. Talk about a rise to the top. Top 5 index funds. Okay, it's time for a quick breather. We know we have dumped a lot of information on you, but I promise if you stick it out, you won't regret learning about all the low-cost, high-reward investment index funds offer. If you're looking to invest, Here are 5 of the top performing index funds that you should consider. Number 1. Schwab US Large Cap ETF. Schwab US Large Cap ETF has been around since 2009. This index fund focuses on stocks in the tech sector and buys stocks in companies such as Apple, Facebook, Microsoft, and Tesla. The fund's market ticker is SCHX, and it tracks the Dow Jones Market Index. With stocks from over 750 companies, diversification is a worry of the past. They boast a 5-year return rate of 106.20%. Number 2. Vanguard S&P 500 ETF. Run by the company started by John Bogle, the Vanguard S&P 500 ETF is one of the best ways to invest in industrial sectors and consumer healthcare. This index fund has been on the market since 2010 and has a 5-year return rate of 101.28%. Their ticker is VOO, and this fund boosts high liquidity due to the over 916,000 shares per day. Number 3. Vanguard Total Stock Market ETF. The Vanguard Total Stock Market ETF is one of the oldest on our list and has been kicking around since 2001. This fund tracks the CRSP U.S. Total Market Index. It is made up of over 3,500 companies from major consumer and industrial sectors. Their ticker is VTI, and you can expect an average 5-year return rate of up to 104.71%. Number 4. iShares Core S&P 500 ETF. Since 2000, the iShares Core S&P 500 ETF has been making investments in the IT, healthcare, and consumer staple companies such as Home Depot, Visa, and Procter & Gamble. This fund also boosts high liquidity, and they complete over 1 million trades every single day. With a return rate of 100.75% after 5 years, it is an easy choice as a top index fund. Number 5. Invesco S&P 500 Equal Weight ETF. The last spot on our list goes to the Invesco S&P 500 Equal Weight ETF. This fund has been open since 2003. Their return rate is a bit lower than the rest of the index funds on our list, but falls at a respectable 81.09%. RSP is their market ticker, and the stocks they invest in come from IT, healthcare, and finance. How to invest in index funds. Alright, so we know the basics, know the history, and now know some options. Let's talk about how you actually make your investment. First, you have to decide which index you want to invest in and which index fund management you want to give your money to. To buy the actual shares, you open a brokerage account with a broker who can help you buy and sell your chosen index fund shares. However, make sure to shop around. Some brokers charge an additional fee to invest in index funds. This defeats the whole purpose of index funds to be a low-cost way to start investing. We have listed some of the most recommended brokers in the description below for you. Money Masters hot tip number 1. Finally, we wanted to give you guys 2 of our biggest tips for index fund investing before we go. We present one of the biggest common sense tips. Invest wisely, invest frequently. This should be self-explanatory, but the concept behind this is that you should invest reasonable amounts of money based on your budget, and you should do so as frequently as possible. Compounding is on your side with index fund investments, and you don't have much to lose. Let us look at an example. Say a 20-year-old decides to invest $150 every month. By the time he or she is 67, if invested every month and received an average annual return of 8%, the portfolio will be worth $851,172. In another scenario, if a 30-year-old decides to invest $200 every month, by the time he or she is 67, if invested every month and received an average annual return of 8%, the portfolio would be worth $760,821. The good news is that there are some index funds that have earned average of 12% in previous years. So if you want our advice, start now and start right and invest as much as you can afford. Money Masters hot tip number 2. Our second hot tip has less to do about the financials of investing and more to do with the timing of investing. Many people under the age of 30 and above the age of 60 have resisted buying stocks. This is due to a multitude of factors, but chief among them was financial literacy. It is crucial for you to know that it does not matter how old you are, where you work, how much money you have in your savings account, or what your SAT score was. Index funds are investments that reward the buyer's patience. But for your investments to mature, you have to have time to age them. So buy your index fund shares now and begin to learn the art of patience and commitment. The best time to start investing was 10 years ago. The second best time is right now. You see, index fund investing is one of those topics that seems confusing at first, but is relatively simple. We hope this video helps give you a better understanding of index funds and their potential benefits to your financial success. Money Masters is committed to teaching you about how to achieve your wildest dreams. But to stay up to date, you'll need to like, comment, and subscribe to Money Masters. Don't worry, we look forward to inspiring you to succeed.